Grab your paper and pen and enjoy the video. Most people don't lose money because they invest badly. They lose money because they don't understand what they're investing in. Today, I want to walk you through the main investment options people talk about, what they really are, how they work, their risks, and who they actually make sense for. This is not about hype. This is not about quick money. This is about understanding your options so you can make better long-term decisions. Let's start with the foundation. Part 1. Fixed income investments. Fixed income investments are usually the first step for people who are starting. These include things like government bonds, treasury bonds, certificates of deposit, savings-linked products. The idea is simple. You lend money, and you receive interest over time. Fixed income is not about getting rich. It's about preserving capital and reducing risk. Pros: predictable returns, lower volatility, good for emergency funds. Cons: lower returns over the long term. Inflation can eat your gains. This type of investment is ideal for beginners, conservative investors, short to medium-term goals. Think of fixed income as the anchor of your financial life. Part 2. Stock market investments. Stocks represent ownership. When you buy a stock, you're buying a piece of a real business. Stocks offer higher long-term returns, but they come with volatility. Prices go up, prices go down, sometimes for reasons that make no sense. Pros: high long-term growth potential, ownership in real companies, liquidity. Cons: emotional pressure. Short-term volatility requires patience. The stock market rewards time, discipline, consistency. It punishes panic, impulsiveness, short-term thinking. Stocks are best for people with long-term goals, emotional control, a system, not guesses. Part 3. Real estate investment trusts. Real estate funds allow you to invest in property without owning property directly. These funds invest in office buildings, shopping centers, warehouses, hospitals. You earn money through rental income, asset appreciation. Pros: monthly or quarterly income, diversification, lower entry cost than buying property. Cons: market fluctuations, management fees, interest rate sensitivity. REITs are a middle ground between stocks and physical real estate. Part 4. Buying property to rent. Buying an apartment or house to rent is one of the most traditional investments. You earn through monthly rent, property appreciation. Pros: tangible asset, inflation protection, long-term stability. Cons: high upfront cost, maintenance, vacancy risk, low liquidity. Real estate is not passive at the beginning. It works best for people who think long-term, are comfortable with illiquidity, want stable income, not speed. Part 5. Consorcio. A consortium is not exactly an investment. It's a forced savings mechanism. You contribute monthly and receive access to a large purchase later. Pros: discipline, no interest like traditional loans. Cons: no return on capital, timing uncertainty, opportunity cost. A consortium can make sense for people who struggle to save on their own, but it should not be confused with investing. Part 6. Cryptocurrencies. Crypto is one of the most misunderstood investments. It offers high volatility, high potential, high risk. Pros: innovation exposure, asymmetric upside. Cons: extreme volatility, regulatory uncertainty, emotional trading. Crypto should be treated as a small portion of a portfolio, a high-risk asset, not a financial foundation. Never invest money in crypto that you cannot afford to lose. Part 7. Buying and selling products. Buying products and reselling them is not investing, it's business. You invest time, effort, skills. Pros: control, cash flow, scalability. Cons: requires active work, no guaranteed returns, operational risk. This is ideal for people who want income growth, skill development, independence. Your biggest asset here is not money, it's execution. Part 8. Diversification and strategy. The smartest investors don't choose one option, they combine them. Fixed income for stability, stocks for growth, real estate for income, small risk allocation for innovation. Diversification is how you survive long enough to win. Final message. There is no perfect investment. There is only the investment that matches your goals, your timeline, and your behavior. The more you understand your options, the less you depend on luck. If this video helped you, subscribe and leave a like. This is Money Unscripted, where clarity comes before profit.